I am now going to provide a couple of comments after reviewing the projects, and we had the initial review for the 2020 projects, and I'm just going to provide a little background here. First off, I want to say that when I reviewed these projects, most of them were excellent. They were just really good. Yeah, it was clear that it had taken a lot of time doing the whole project. It was very much a pleasure to look at these. Many of you and I should have expected this. Many of you did pick a stock index fund and a bond fund and followed Jack Bogle's recommendation. That is absolutely fine. And when I develop these assignments, I have to be a little bit careful here of providing. I used to do this with virtually no guidance at all on what assets to put in a retirement portfolio, and a lot of times I would get retirement portfolios that I thought that the assets were inappropriate. For example, one year, one person put in the entire portfolio in Chicago municipal bonds. And if you know anything a lot about Chicago municipal bonds, they have a very low rating, high risk. So you probably don't want to bet your retirement on those. Again, what you did is fine. If anything, I would suggest you be a little bit more aggressive overall. Think about putting some of your funds in some more risky mutual funds. And again, don't do this for this assignment, but as you're making your investments, just be a little risky. You're young, take the risk. I might even suggest doing some fun things like pick a stock, Tesla or whatever you want. Invest something in it, but do it with the 90% or 80% in the stock index fund and a bond fund, but have some fun picking stocks and take a little bit of risk. All right, one of the things that came up a lot was the time period of the data that was used to calculate returns and then risk. If you picked a period from 2010 on, you will have high returns showing up in that portfolio. If you pick something in the 1990s, you will have low returns. And I'm just going to illustrate that now. And I'm going to illustrate that with two funds. Our typical Vanguard 500 fund, which is one that many of you picked. So when you're looking at these examples, I'm going to show you how the period that you picked influences the expected return level, and for that matter, risk level. So we're going to do the Vanguard 500 fund, which is an index fund. It replicates the Vanguard 500, S&P 500. Large cap, expense ratio 0.4, portfolio turnover 4%. I'm going to compare that to Fidelity Magellan, which is a number of you picked Fidelity Magellan. And this is a very good fund as well. It happens to be actively managed. It seeks capital appreciation. Fidelity Magellan was actually the fund that sort of got the mutual fund industry going big time. It was the first really big fund. Again, it has large cap growth. Look at the expense ratio from Fidelity Magellan to the Vanguard 500 index fund, and you will see it's quite a bit higher, 0.77. That's at 0.77 is still a very good expense ratio for a actively managed fund. But compare that to 0.14, and then the other thing to look at is portfolio turnover. And I always look at that as for how actively managed it is. You can see that it turned its portfolio over completely one time and 6% more. What I did here with these two funds, and let me bring this into play here, is I got their funds from Yahoo Finance. Here's a Vanguard 500 index fund, and I will link this spreadsheet, put it up there. It will be in our modules with all of our wealth modules in it. So I have the Vanguard 500 index fund there, Fidelity Magellan, and this is the data I got. I calculated two things over here. First, I took the adjusted close and divided it by the first adjusted close. So that puts both, and I did that for Vanguard 500, Fidelity Magellan. Did that for both of them, and then over here is the return calculation, daily return calculation for each. All right, I did that. So every adjusted close is divided by the first close. Okay? And let's go. So we got both of this data from 1980. I'm going to go down to the end, and I got it down to 12/4/20. You can see here, dividing it 7203, 100. Oops, I did something wrong. There we are. 105.45. Here's the graph of those two. Here's what this means. If you took $1 and invested in January 2, 1980, $1 in blue would be VFINX. Here is orange is Fidelity Magellan. You would have $72 if you've invested in an index fund, $105 here in the Fidelity Magellan. Just bring this out. You can see that they follow close to each other, and actually, as at the end of January, right here in 2009, you look how this is the 2008 crash here. Look how much more this Fidelity Magellan fund went down compared to the VFINX. Overall, you would be, over this period, you would be better. 72 versus 105. Actually, that's quite a bit of difference. So that gives you a comparison of those two. Actually, also, if you're looking at those two, if we conducted a statistical study to ask if they had differences in returns, we would likely end up with the conclusion that they don't. I haven't done that analysis, but it's very hard to conclude that they don't. All right, let's go to the top here. Here I have calculated returns for different periods. Here's from, and they all end with our December 4th date. This one begins in 1980. This one begins in 1990. 2000, 2010, 2015, and then 2018. For each of these, calculate let me start here. This is the calculation of the geo mean given the whole period. Here's the count. Do that for both VFINX, Magellan, standard deviations, and then come over here and annualize the returns, just like we always do, annualize the standard deviation. I did that, and now I'm going to bring that up and put it on this slide here. So this is what we found. VFINX, which I spelled wrong here. I'm doing this fast. VFINX. So I missed this. But this is our S&P 500. From 1980 to 2020, it had a 10.986% return. Instead, if you started in 1990, you would add 9.96% return. You began in 2000, you would have 6.44% return annualized. And then going forward, 13.55, 12.545, 13.38 since 2018. All right, here's the point. A number of you had assets that sort of started in the mid-1990s, and you sort of got a 6.44% return. Yeah, that is true. Here's what happened, though. You went through the 2000s. First, there was 2000, 911, that recession, and then 2008 as well. So you over this decade, if you had $1 at the beginning of the decade, you would have roughly $1 at the end of the decade. The returns were awful during that decade. So if you include that, you have very low returns even after going up to 2020. All right, so what does this mean? First off, If you have assets that are very short, you're going to have a pretty high return. All right. And this is just me, if I look at that asset and think about it in geo-means place and think about S&P 500, I'm thinking about a 9 to 10% return. Again, if you come here and pick the 2000 or late 1990, you're going to get something like this. All right, what does this mean? What does that number mean if we look at the 40-year wealth? Well, it means a lot. And these numbers I put in our wealth model, our Colab, you can see 2.8 million versus 851,000 versus 5.7 million. All right, so I made a number of comments on you that are up here that you might want to lengthen your period. And if you can, do so. If you can't, just simply indicate that those might be too high when you run the wealth model. Because frankly, if you have a stock index and are putting 13% return in there, even though your data is saying that for the last couple periods, I simply don't believe you're going to have that much period. And now think about if you're sitting with a client and you begin putting those numbers before them, you're sort of misleading them. So I would suggest, temper that. If you're high, be more optimistic when you're low. All right? And again, those have big impacts on our ending wealth level. All right, so that also suggests that period matters, and it does. And remember that when we are looking at the wealth model, the portfolio model, we are really saying this is what the expected return we expect to see, and we're using past data to inform that. And there will also be some, you will have to use some judgment there, particularly if you're looking at pretty short time periods. All right. So that's the comment. If you have some short time periods and can lengthen them for the project, do so. If you can't, I would really like you to mention in your report and say, these returns are high, or if you're here, they're low, that you really do believe that you should be more optimistic. Just note that in your report. Again, as I looked at those projects, they were really well done, and I really appreciate the hard work that you have put into those.